If you are starting out your business in Ireland as a sole trader, there's one thing that tends to throw a lot of people, and that is timing doing your set of financial accounts for your sole trader business and timing that with doing your income tax returns, your Form 11 each year. So, in this video, I'm going to go through exactly how it should work in the first 3 years from when you commence your trade. And after this, you will know exactly what your responsibilities are and when you should be filing income tax returns and how you calculate the profit that should be included in those returns. The main point of confusion that people face is they start their trade, let's say, for example, later in the year. And normally, when you think about an income tax return, it kind of works on a January to December year. But what if you start your sole trader business in, say, October or November? Are you obligated to do an income tax return for that year, or how does it work? So, we're going to go through a real life example here and tell you exactly how it all works. So, yeah, the main point of confusion is for people who are starting out a trade or a profession, so Schedule D, Case 1 or 2 income in that instance. The main point of confusion is what period should your financial accounts cover when you're doing your income tax returns for your Form 11 in the first, second, and third year after commencing your trade or profession? And as I was saying, many people will register for income tax and commence their trade or sole trader business in the middle or later part of the year and then can be confused about what their responsibilities are in terms of submitting an income tax return, or commonly also known as a Form 11. So let's now go through our example, which will explain it a lot better. So in this example, we have Billy's Butcher. So he commenced his trade on the 1st of October in 2023. And then below this is a summary of his accounts and profits over the following financial period. So exactly 12 months after his commencement date, he made €19,000 profit. And after that, he made a profit of €14,000 for the 12 months to 30th of September 2025. And then he made a €30,000 profit in the 12 months ended 30 September 2026. So, how does it work in his first year? So, the general rule is your first income tax assessment is based on the profits arising from the commencement date of the trade or profession to the following 31 December. So, for example, if you are an individual who registered as a sole trader on the 1st of December in 2023, you would still need to complete an income tax return or Form 11 for 2023, and that will need to be submitted by the 31st of October 2024 or mid November if you are filing on Ross. So you would still need to put in 1 month's profit from your trade into your income tax return for 2023, even though you've only started trading in the last month of the year. So if we come back to Billy's Butcher, he started on the 1st of October 2023. That will mean for 2023, he's going to have to report 3 months profit, so from October to December. So we already saw that he made a €19,000 profit in the first 12 months of his business. He did up accounts for the first 12 months. So what we can do is we can use those accounts and we can time apportion them. So we can divide his profit of 19,000 by 12 and multiply that by the 3 months, which gives us a profit of €4,750, which we can use for the 2023 income tax return. Then when you come onto your second year, the rules are slightly different. In the second year, you'll be assessed on the latest set of accounts, which is 12 months in length and ending in that year. So any 12-month set of accounts that ends in this year. If there's more than one set of accounts that end in that year, then you will use the latest set essentially. And if you have a set of financial accounts that ends in the year but is longer than 12 months, then you will time apportion it down to the latest 12 months in that period. And finally, if there is no accounting period ending within that year, what you will need to do is compute the profit on a calendar year basis. So you will take whatever accounts that you have over that period and apportion it so you get the January to December profit for that year. So then if we come back to Billy, if we're looking at his income tax return for 2024, he had one set of accounts that ended in 2024 that was 12 months in length. They ended on the 30th of September 2024, and he made a €19,000 profit in that set of accounts. So therefore, we will be using €19,000 profits, and that will be reported in his 2024 income tax return. So that's kind of fairly straightforward. Then as we move on to the third year, again, the same rules apply. You'll be assessed on the latest set of accounts with a 12-month period that ends in that year of assessment. And if we bring this back to Billy again, so Billy had in 2025, he had another set of accounts which ended on the 30th of September 2025. So we'll use this set of accounts and they had a profit of €14,000. So in the third year of assessment, what you can also do is look back retrospectively at your second year and assess whether the profits that you actually returned in your income tax return were higher than the calendar year of January to December. So if I worked out what the actual calendar year was for 2024, what I would do is I would time apportion his first set of accounts, which ended on the 30th of September, divide that by 12 and multiply that by 9. So 19,000 divided by 12 multiplied by 9. And then I would take 3 months out of the next set of accounts. So I can get the October to December 2024 portion out of this €14,000 profit in year two. So when I do that, the calendar year profits worked out to be €17,750, a difference between what I actually reported, which was €19,000. So I kind of over reported. So what they will allow me to do is that difference of €1,250, they will allow me to deduct that against my year three profits. So my year three profits were the €14,000, as we mentioned up here at the top. So I can deduct the €1,250 from that, and that results in an assessable profit for 2025 of €12,750. So that is essentially how it all works. It can be quite confusing until you know these rules, but when you get your head around them, it's actually quite straightforward. So if you have any questions in relation to anything like this or any questions about starting a business in Ireland, you can always drop me a message down below or email me, or my email is also down below as well if you want to reach out.